Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from our friend and colleague, Justin Huhn, founder and publisher of the Uranium Insider, and one of the more knowledgeable people in the nuclear fuel cycle and uranium sector. And Justin, it's always great to have you on the show. We were just talking off mic that I can't believe, and I don't think you could believe that it's been since Christmas that we've talked. We were talking on Christmas Eve, so it's been 6 months. Half the year has gone by, Justin, and we're just now starting to get into the uranium cycle here on the KE report with you. There's a lot of news that's hit the sector, probably too much to cover in one interview, but I want to kick things off with part of the reason we hadn't chatted was that uranium stocks and the sector was in a slow slide the beginning part of the year. Things bottomed out in April after the Trump Liberation Day, the tariff tantrums in the market, almost all sectors got hit really hard in April. But for the last 2 months, you've seen a big uptick, almost a V-shaped rebound in the uranium equities and nuclear stocks. And some of the fuel for this, no pun intended, was the four executive orders that the Trump administration put out. Now, these are, in my opinion, icing on the cake to a fantastic fundamental supply demand picture with nuclear fuels, with uranium. But because they're getting so much airtime, I thought we'd just start there, Justin. These four executive orders from the Trump administration. What do you think the main takeaways are for the sector?
Sure, it's always great to speak with you, Shad. I couldn't believe that it's been since December. I could have sworn that we spoke just a few months ago, but the sector has really accelerated the past couple of months, and you're absolutely right. It was a painful and somewhat boring at times, Q1 and early Q2. So plenty to cover. The executive orders were a significant tailwind for the sector, and we saw the sector rebound in terms of the uranium and nuclear equities pretty significantly following those orders. And there were four executive orders that were largely, if not specifically, in support of domestic nuclear energy, the fuel cycle, uranium mining, and domestically, et cetera. The main takeaways from these orders, really, I would say the things that really stood out were the streamlining of regulatory processes. So there's definitely within these orders an overhauling of the NRC, the Nuclear Regulatory Commission, requiring it to revise regulations within 18 months to expedite reactor licensing. And so this is probably one of the more controversial elements of the executive orders because there's certainly plenty of nuclear advocates that are basically saying that the NRC, a little bit of reform might be helpful, but it's not really the NRC that's slowing down the growth of nuclear in the United States. And I would agree with that, actually. There's dozens of reactor sites that are already permitted to build additional reactors. There's dozens of reactor designs that are approved, including Westinghouse's AP1000. So what this is really kind of focused on is new reactor designs, advanced reactors designs. Many of the small modular reactors are quote unquote Gen 4 or advanced designs. So these are, high temperature operating on HALEU, different types of reactors besides light water, boiling water, which makes up the entire US fleet currently. So that was kind of one element is looking at the NRC, figuring out and setting a timeline to actually reform it to bring new reactor licenses down to a 12-month deadline. So that's kind of what they're shooting for with the NRC. And hey, if they get it done and we can speed up the approval process by refinements, by improving efficiencies rather than reducing safety, I'm all for it. And certainly there were elements of the executive order around the NRC that were somewhat critical. So the NRC took over from the Atomic Energy Commission that was put in by Eisenhower, and this was back in 1978. And since 1978, two reactors have been built in the United States. And that's not entirely to blame on the NRC, but the NRC certainly in its history has had plenty of, tried and true anti-nuclear people at the helm at NRC. So getting pro-nuclear people into the NRC and actually making some reforms to their processes is probably going to be very helpful for getting nuclear off the ground again in the United States. Another executive order focused on expanding nuclear in the United States. So there was a goal to, or there is a goal in one of these executive orders to have at least 10 large, like AP1000 size reactors under construction by 2030. And this is probably I would say the most shocking piece of these executive orders because it's been so long since the United States has built, well, really kind of anything in fleet mode, but especially with nuclear. And so within 3 weeks of these executive orders, Westinghouse actually made some headlines about 10 days ago saying that they have a proposal, I believe it was 72.5 billion to build 10 AP1000s. And we believe that Westinghouse is working with some nuclear developers like the nuclear company in the United States potentially as well with nuclear utilities and possibly even involving tech companies. So trying to get large reactors off the ground soon is a big element of this executive order. Overall, I would say that the executive orders are pointing towards an administration that knows the importance of building more nuclear. They understand the challenges that lie ahead in terms of the strains on the grid with electricity demand growing very, very quickly. And a big part of that is the growth of data centers and AI. It's not the only story. It's still kind of electrify everything. Electric cars, electric heat, electric cooking, all of these things are expanding in the United States and kind of everywhere. So electricity demand is growing globally, but especially in places like the United States where we have a lot of data centers. And the other overall overarching theme, and I'll end on this, is definitely a focus on advanced reactors. And so there's elements of further incentivizing HALEU production in the United States. They want to facilitate faster new reactor design testing at the national labs, et cetera, et cetera. So overall, very quote unquote bullish for the sector to see what is still the largest nuclear market in the world, which is the United States. We have almost 100 gigawatts, considering the upgrades that the reactors have done over the past 5 years. We're pushing 100 gigawatts on full capacity, and still the largest market in the U.S. But we haven't really built anything Vogtle 1 and 2 in the past 30 years. So incredible to see at least this type of language and intention. And while it would be natural to have a healthy amount of skepticism about these goals being met, it does appear that the industry is organizing around some of these goals. And we can get deeper into that. But very big news to see the nuclear leader, let's say, as far as capacity goes, the leader as far as getting stuff built is obviously China, probably secondarily Russia, but the US sees the challenges with those two markets and is trying to grasp some of that as well, even including exports.
Yeah, I think overall it's a net positive for the sector, Justin, just because it puts a spotlight on the nuclear sector in a way that we haven't seen since Eisenhower, since Ike. So it's interesting to see how much traction it's gotten in the media as well. And because they cover everything the Trump administration does, they're now covering nuclear. Even outlets that I wouldn't even have thought were covering nuclear now covering it. And there is a line in there where they want to have the expansion of American nuclear capacity from approximately 100 gigawatts in 2024 to 400 gigawatts by 2050. So that's an audacious goal, but hey, at least the industry is mobilizing around it. I want to kind of pull on the string that you mentioned there about a lot of the focus is on these small modular reactors. Man, we hear a lot about that, Justin. We've seen companies like NuScale Power and Nano Nuclear and Oklo really race higher because they have these designs. We know that TerraPower, which is the private company, is also working on small modular reactors. A lot of the tech giants have come out and announced that that's part of their initiative. And while that's all exciting, and while that's all coming, and that's all maybe 5 years away, there was already a great fundamental case for a big reaction in the uranium price, both the spot and the term pricing, and also the uranium equities, just based on the mundane reactor builds that are going on globally, the restarts of reactors that were currently down but then are restarting, and also a lot of life extensions to reactors. I think over around 15 in the US have been extended now, and they've been extended in other areas. So could you maybe help us separate the signal from the noise as far as the fundamental supply demand that already existed before AI data centers hit the market's attention over the last year, and how significant just the overall global reactor base is to the picture in the uranium markets?
This is probably one of the more exciting elements of this investing thesis, Shad, because SMRs are still basically in their infancy. These are the warm-ups before the first inning. China has built one. You could argue that nuclear submarines are small modular reactors. So we know how to build these things, but there's over 100 different designs from over 70 or 80 companies that are working on both private and publicly traded that are working on SMRs. So the demand that will come from small reactors is almost entirely, if not entirely, right tail. So what I mean by that is that we have a model for supply and demand that's built out. It's very extensive, these very complex spreadsheets looking at all of the global reactor fleet, the demand that we're expecting from the existing fleet. So that is to say what reactors are operating until what year we expect them to operate Will they see life extensions or not? We have to bake in, certain assumptions around that, but it's largely known what is operating, what will be operating in the next 7 to 8 years with very high confidence. And that includes, of course, what's under construction now and will hit the grid during that time frame. So over that time frame, there's very little SMR demand that we have baked into our model. And the same goes for models done from Katie LaChapelle, contact of ours at Canaccord Genuity, from the guys at Sachem Cove, the guys at Segra. Most of these models, these demand models, are highly conservative. We only want to be highly, highly confident in what we know. What's operating, what will be life extended likely, what's under construction and will hit the grid during a reasonable time frame. SMRs, however, because it's so early, everybody thinks this is a 2030 story. And in many cases, it is in terms of actual capacity from newly built SMRs being grid connected and equaling burn up on an annual basis. However, the first small modular reactor being built in North America is being built at the Darlington facility in Ontario by Ontario Power. This is a GE Vernova, GE Hitachi BWRX 300. The shovels are already hit the ground. They're working on site prep. They're working on early construction of that. As soon as that reactor project was approved, OPG was in the market with an RFP for uranium. And that was in 2023. So this reactor is not expected to be operational in 2030, 2031. And so they were in the market 6, 7, potentially even 8 years before that reactor will be operational buying uranium. The main thing that is keeping SMR demand in terms of capacity from equaling uranium demand to the market is literally approvals and knowing that the project will happen. And as soon as more of these are actually approved and construction starts, you're going to see uranium demand in the market. So just to give you an idea about how significant SMR demand is and could be, if we look at studies done on the pipeline for small modular reactors, so any stage of planning, these are early MOUs, these are letters of intent, these are early stages of planning, but at least it's a site, there's a site that is in mind for this reactor, there's a deal being done. These are in some stage of planning, possibly even early construction with a handful of these around the world. The total pipeline capacity for small modular reactors as of Q1 of this year was almost 50 gigawatts. 50 gigawatts. It's almost 50 AP1000s or 50 Hualong 1s, right? 45 of those big reactors. 1 year ago, the total pipeline for SMRs was about 23 gigawatts. It has doubled in 12 months, the pipeline for small modular reactors. This has the potential to snowball in a major way. And the best part about this is that we don't need any SMR demand, according to our model, to still have significant shortfalls in supply in this time frame, this 5 to 10 year time frame, where we will absolutely see these shortfalls lead to higher prices in uranium. SMRs, how quickly they hit the grid, how much the demand for these globally increases from here on out, it's all gravy. It's all gravy. And we know that it's happening. And there's been a big push, obviously, in the United States, but a lot of people are focusing on the United States, and that's not the only story. Japan is looking at SMRs. There's dozens of SMRs planned in Europe. There's a handful in Africa. It's a big theme that's really taking off, and that's the best part. We don't really need it. So whatever does get built or even enters the pipeline, gets approved, and a shovel hits the ground, that's going to be demand that largely is not in our model. We do model for some SMR demand, but that demand actually in our model doesn't even start until 28 or 29, if I recall correctly, even though we've already seen demand in the market. So we model it extremely conservatively. Everybody that I know who has built models is doing the same. It's all upside.
Well, and to that point, let's just put the small modular reactors and all of that future build on a shelf as future gravy. But let's deal in the real. Let's deal with the reactors we have now, the reactors being built, the life extensions, and the restarts. What we have is a global fleet. I think it's around 440 reactors, give or take. But there's about 68 that are being built or are planned, and they're coming online in the next decade. And so you got a steady stream of new reactors that are going to be hungry for feed, as well as the existing fleet of reactors. And when you look at the supply side of the equation, there's not a ton of new supply coming on. So let's point out for people that if just with the environment we have, Justin, as far as new supply, the U.S. production has been a little checkered over the last year or two to get some of these smaller producers up and running. We've had problems with Paladin at the Hanger Langrick in Namibia. Obviously, Kazakhstan and Kazatomprom has had its own challenges with both the acid that they needed for their leaching, but also by the weird tax code that they put in place that started being punitive towards increasing production. You've seen Cameco's JV and Kazatomprom maybe not get as much as it was hoping to get out of that this year. And then you have a lot of people looking to Canada to say, oh, hey, don't worry, we've got these big projects coming online. And they don't look like they're anywhere close to being ready. It looks like their timelines are being pushed back. So give us an update on where is the supply going to come from to fill the demand, Justin?
Yeah, this is something that we've written extensively about, especially over the past 6 months, because we feel, in our estimation, that the focus on this investing thesis has shifted from stable and slightly growing demand to the supply is really the big story here. So if we go back to 2016, 17, 18, the early days of this investment, let's say, commodity bottom, spot uranium bottomed in late 2016. Looking at the industry back then, it was at a 1 or 2% annual growth rate. The thesis largely was, okay, this industry still exists. It's growing a little bit. The demand is stable. The price is less than $20 a pound, and the cost to pull it out of the ground on average globally is 40, 45. The price has to double from here, period, the end, in order for the sector to balance. And that was the contrarian bet. It was difficult to measure how much above ground mobile inventory. We could probably get a measurement within about 20 or 30 million pounds, up or down from the actual number, but there was definitely north of 100 million pounds still at that point of above ground mobile inventory kind of floating around out there in the industry. So we didn't know when it would turn around, but we knew that it had to eventually. Once the industry worked through that inventory and we got back to what it cost to pull the stuff out of the ground, we would see the price recover. And we were right. And everyone else that made a contrarian bet at the time was right. And we've seen the price go from 18 a pound to 106, pull back down to 63. Here we are at 74.50, 75 is the bid ask right now today in the spot market. Term market is $80 a pound. 3 year forward, 5 year forward are pushing, high 80s, early 90s. So the sector has recovered in price. It absolutely has. Now we've gotten to a point where, regardless of incentive price, and we believe incentive price for the marginal projects that will have to come online in order to balance this market in the 2030s. Honestly, it should have been done multiple years ago to get that started, but the price wasn't there. And most importantly, the signals from the nuclear utilities wasn't there and still largely isn't there, which is, hey, we're willing to sign high volume, large contracts with developing companies at the prices that they want. That's what we have yet to experience, and that's what is coming. So that's what's exciting on the price front there. As far as supply goes, the big difference right now versus not only just at the beginning of this cycle, but looking back at other cycles, is that there's nowhere else for the pounds to come from to meet the demand of the reactors of the world for the next 5 to 10 years, besides out of the ground. So there isn't an overhanging enormous amount of inventory. Even the very, very conservative UXC, which is one of the top, nuclear fuel analysts and price reporters, stated 2 years ago the age of inventory overhang is over. So the flex coming from down blending, megatons and megawatts for 20 years, 93 to 2013, 20 million pounds a year was down blended in Russia and sent to the United States fleet. That ended in 2013. Enrichment underfeeding, there's zero happening in the West. So 40% of the globe's underfeeding is not there. That used to be, 20 to 25 million pounds a year in underfeeding. Now maybe we're getting 10 or 12. Far less secondary supply, very, very little inventory out there for sale globally. So what that means is the demands of the global reactor fleet, the actual burnup of the fleet is going to have to be fueled by uranium coming out of the ground. And now that sector, that sleepy, boring sector back in 2017 that was growing at 1% per year, in our model, based on what we see, not what we expect or hope for, but what we actually see in terms of reactor builds and life extensions, et cetera, we see between now and 2035 a 3.1% compound annual growth. If the industry globally is to start building sufficient to reach a tripling by 2050, which were the goals of the COP 28, 29 conferences, we would need a 4.4% compound annual growth rate. So even at a 3% growth rate, we see significant deficits in supply. We see deficits of pushing 400 million pounds of insufficient supply between now and 2035. And that includes big projects that we do expect to get built, which only is going to happen if prices are higher. So the supply side is, let's just say it's fragile. It is certainly trying to respond. We are going to see incremental increases in supply year over year going out towards the end of this decade until we start to see some of these big projects that are producing now start to come offline, like Cigar Lake. That'll be done essentially by 2030, 2031. Langer Heinrich is done in the 2030s. Half of the projects in Kazakhstan are done by 2035. Rossing is done early 2030s. Husab is done by the end of 2030s. I mean, these are the big, major producing mines of the world right now. And they are all going to be in decline. Many of them will be in decline in the next decade, right when we see demand really take off. So, what that means, to distill this down, is that the demand has to be met by pounds out of the ground, and any disruption to any of these big projects that most of them have yet to be even started developing, any disruption there, we're going to see reverberations across the market because there isn't a buffer any longer. So we were talking offline, and I know I've quoted this a couple of times too. Mike Alkin from Sachem Cove in a recent interview said they don't look for catalysts, they look for conditions. And we don't know what the next catalyst is going to be. We can make some educated guesses. We are going to see supply disruptions in the next few years. 1,000% that is going to happen. Which company, on which timeline, we don't know, and we don't need to know. What we need to know is the structure of the physical market, the dynamics of the physical market, utilities' current and expected behavior, and what supply is likely to be able to respond to that. And the market is in a certain condition that something will disrupt it. We don't have to know what will disrupt it. We have to know that the conditions are there for disruption. And that's where we're at right now. And we just had news 2 days ago that Sprott raised 200 million in a bought deal. Nobody saw that coming. Even though we had a precedent of them doing a raise at a premium off market 1 month ago, and I was scratching my head why nobody cared that that just happened. It set a precedent that would likely be repeated. Well, now it's repeated, and it's repeated at 8x the size. So this is going to disrupt the market. It's a new paradigm that we're in right now with Sprott being able to raise money in this way. The apex predators are aware. Canaccord going in there, one fell swoop, 200 mil. Okay, that's not small. That's a lot of cash, and guaranteed they've got positioning in the sector as well. So all of this is to say, Shad, that supply is a problem, and we're going to see supply attempt to respond. And anytime there's a hiccup, we're going to see reverberations in the market.
Well, I'm glad you brought up that line about conditions versus catalyst because people do that in every market. Hey, what's the next catalyst, Justin? But the reality is the conditions already exist. There's a huge supply demand mismatch, and it will have to filter its way through utility companies eventually coming down and contracting with uranium companies for a price that incentivizes them to pull it out of the ground. And some of the contracts that we did see, had floors of $80 like the one that NextGen signed and ceilings of 150, which just goes to show that even the utility companies realize pricing could still go far higher than it is today, and it probably will. And if you have both Yellow Cake and the Sprott Physical Uranium Trust going in and sopping up the spot market, there is no spot market to go back into, relatively speaking, to soak up the amount of fuel that the utility companies are going to need. And that brings up the point. We hear all the time that Canada is going to be the savior. We're going to get it with NextGen's Arrow deposit, with the Phoenix deposit from Denison. But Justin, those timelines keep getting pushed back further and further. There were people convinced a couple of years ago, 2028, those will all be coming online and it'll balance the market. Now it looks like 2030 at the earliest for some of these. And even then, that doesn't mean that a larger apex predator, to bring in your verbology there, couldn't come in and swoop in and take over those companies and hold those pounds for a later date. There's also the inevitable rule of mining that everything takes longer and it costs more than anybody's planning on. So when you look at new supply, where is it coming from in the mining companies, Justin?
So there's a few large projects, and one in particular that I think is really the focal point of the industry and of the supply deficit going forward. And as far as the apex predators comment, I have to give credit to Nick Lawson from Ocean Wall. I borrowed that from him, and I think it's a perfect analogy for what we just saw a couple of days ago with Sprott's announcement. But coming back to supply, NextGen's Arrow project, according to their feasibility study, they're really trying to highlight and let's say maximize the project NPV and really pull it forward in the first 5 years of the mine life. So according to their feasibility study, they will be bringing that mine online. In the last feasibility study, the feasibility study was based around a 40-month construction timeline or 36-month construction timeline. Then it went to 40, then went to 42. The most recent update is saying 48 months of construction. This project they have in their feasibility study as 29 million pounds produced per year for the first 5 years. So the bulk of the NPV of that project is accelerated into the first 5 years of the life of the mine. And most people in the sector believe that that was done to really bring attention to the value in the ground of this asset and possibly for entertaining suitors and looking for a buyout partner. Now, that's all speculation, but that's just an interpretation of how they structured the feasibility study. So the important element of that is that that is what investors see, but that's also what utilities see. So utilities are looking at the feasibility study. They're saying NextGen is telling us that they're going to be producing 29 million pounds in 2029. There's no problem here, guys. We just have to sit it out. We got to soak up a little bit of pounds here and there, build up our inventories, buy a little Chinese EUP, buy a little Russian EUP, sign some tiny contracts with these other developing companies, and we'll just eke by until NextGen comes, saves the day, and all the pounds come spilling out of Sput. And it will remind me to come back to that one. So just about 8 months ago, NextGen had Arrow at a 42-month construction timeline with first production in 2029. And the contracts that they signed in December were for first delivery in 2029. Now, nobody knows the intricacies of these contracts, and most of the time for development projects, there's a lot of flexibility in the contracts. So most likely these contracts have provisions where they can delay that first delivery by a year or two, or maybe even more, or more easily get out of the contract if needed, right? So it was more of like a statement to the industry to say, hey, we're going to start contracting here. We are planning on building this mine. Some utilities are kind of throwing the industry a bone, like saying, hey, we're playing ball. We're signing some contracts. These are higher priced, whatever. But of course, with the $80 floor, if a utility has a view that we're not going to see significantly higher prices, but if you just escalate based on interest rates, 75, $80 right now out to 2029, an $80 floor looks pretty good. So this project now, simply over the last 8 months, has gone from 42-month to 48-month construction. And what else has happened during that time period is that the review dates for the project prior to permitting have been set. So the first one will come in the next 3 or 4 months, and the last review will be in February of next year, following which there will be a bit more review by the CNSC in Canada. Best case scenario, they have a permit for Arrow in the middle of next year. Then you add a 4-year construction timeline according to the company, and you're at the middle of 2030, first cake in a can 2031. So even since contracts were signed in December, we're looking at 2 years later for that first delivery than what those utilities signed on for this big project. And that, Shad, is if absolutely everything goes perfectly smooth. Now, I can tell you some very, very informed, very intelligent, and deeply researched people in this sector believe that it'll be many years after 2031 when Arrow begins to produce. And more than likely, that annual production rate will be significantly reduced. And there's multiple reasons for that. If they end up being bought out, or at least on the project level, with a multinational mining company or another major, that mine plan is going to be revised. And it's just the way that they do it. So this is such a linchpin project that without Arrow, the deficit, is double what it otherwise would have been in the early 2030s. It's absolutely imperative that this project gets built, and we think it is highly likely that that timeline is optimistic. And that's not just because we have a bullish bias, it's because that's just how mining goes. The only projects that have actually done well over the past few years are brownfield restarts. Have to give credit to Boss Energy with Honeymoon. They've done a good job with that project. The Russians had a terrible time with that project with a lot of geochemical challenges, and they seem to have figured it out. So that was a good one, but that's also a small amount of uranium, a little over 1 million pounds a year kind of production. So We're talking about a huge, huge linchpin project, and the utilities believe that 29 million pounds per year will start to pour into the market starting, 6 months ago, they thought it was 29. Now it's going to be 2031. Whether or not they're even aware of that, most of them are probably not because they don't have an incentive to actually build out their own models. I can count fuel buyers on two fingers that actually have their own modeling of the future supply and demand for the global fleet. Maybe there's more, but those are the ones that I'm aware of. For the most part, utilities don't have an incentive to time the market, to predict the market. It is historically extremely volatile in price, and you aren't rewarded as a fuel buyer for sticking your neck out and saying, hey, I think prices are headed higher. I think we should get in there and buy now. You just go ahead and buy when your higher ups say, hey, we've got the budget, go ahead and cover what we need to cover. That's just how it works. So it's a head scratcher for investors, but that's how utilities operate. And I think that they're whistling past the graveyard right now. And there's going to be a rude awakening for a handful of utilities that are late to the game. And we're not there yet. That's coming in the next few years. But we're going to move towards that accelerated point in time where we're going to see multiple entities fighting over a limited amount of supply. That's what's coming.
Well, Justin, I think what you just said is so important that a lot of these utility companies are whistling past the graveyard. A lot of them have a complacent attitude, and it seems like even at some of the conferences and the nuclear conferences where people go there and talk to these utility companies face to face or have a beer with them at the bar, they're still not that worried about it. So there's going to be a big wake-up call in the next couple of years. Now, people have been crying wolf for a long time in the nuclear sector, so maybe some investor this falls on deaf ears to them. But there is going to be a point where the only possible reaction is a price response because there's not enough supply coming online. There's all these reactor builds, there's all this future demand. And if some of these larger Canadian projects get pushed back in their timelines or they don't produce what people are anticipating, there's going to be a squeeze on the market. Where do you see the best edge in the uranium equities for investors listening in? Is it in the development projects that can bring production on in a certain amount of time? Is it for the producers that we have now, whether they're US, Canadian, or Australian, that could maybe ramp up production or make an acquisition? Do you put any stock into the exploration companies? Where do you think the best place to position to maximize the cycle is for investors?
Well, thus far in the cycle, Shad, the producing companies and the large caps, and largely that's been liquidity based or liquidity driven, have been the place to be. Historically speaking, during any sort of resource bull market, the mining equities, historically speaking, do eventually provide significant leverage to the rising price of the commodity, and usually the money flows into the large caps first and it trickles down. We have no crystal ball, but that is likely to happen here as well. I think that there's multiple developing companies that are trading very, very cheap right now. There's a couple of explorers that already have very good hits that the market does not care about whatsoever. I wouldn't sleep on those. The producers are the safer bet. If you need liquidity, especially if you want to trade options, those are the way to go. Cameco, for example, is kind of like a nuclear stock now. They've got conversion, they have fuel fabrication, they have potentially enrichment through global laser enrichment, and they have uranium mining, and they have Westinghouse. So it's kind of a one-stop shop. But once you really see the uranium price move, we're going to see a follow-on move for the uranium equities that have underperformed the nuclear stocks. We see that flipping. As soon as we start to see the price move, we're going to see much, much, much more upside to the uranium equities once they start pricing in, 90, 100, $100, 10 plus uranium. There's going to be a big re-rating across the sector. So we really like the developers and a couple of explorers here. We're very bullish US uranium developers and producers as well.
Yeah, and it seems like the US are the only companies that have actually gotten any new production online. Granted, it's not much, but there's a handful of companies that are actually ramping up into production right now and seeing some progress made. And maybe there's some consolidation there. And there's a lot of development projects in the US and Canada that do look promising that they could be future supply. So we'll definitely keep tabs on it. And we'll keep tabs on the whole nuclear fuel cycle. And we're in a wild environment where, as you said, the conditions are really what's important. We're seeing Germany pivot back to accepting uranium. We're seeing a lot of companies backtrack and decide that they need to have nuclear as part of their future. We're seeing so many reactor builds and all this information on AI data centers. So it's just so much to keep tabs on. But what we can say is it's a very bullish tailwind blowing on the sector, and we'll definitely keep following along with it here at the KE report. For those of you that want to get more information from Justin, I definitely recommend checking out Uranium Insider. Justin is a wealth of knowledge on the sector. He shares all kinds of information with subscribers on how the nuclear fuel cycle works, what companies can take advantage, his portfolio that's now more of a trading portfolio where he's changing the weightings within the positionings. It's just a wealth of information over at Uranium Insider, and we'll put a link to that down below. Justin, thanks for coming on the KE report, and hopefully we talk a little sooner than 6 months next time. Looking forward to our next conversation.
Thanks so much, Chad. Great to speak with you again.